Imagine this. The IRS just slipped in a game-changing rule that could slash your tax bill by thousands without you lifting a finger. But if you're 65 or older and haven't heard about it yet, you're probably leaving serious cash on the table. Stick around because what I'm about to reveal might be the biggest financial boost you've seen in years. If this sounds like the money-saving tip you need, smash that subscribe button right now to never miss out on more insider secrets like this. And drop a comment below letting me know if you're over 65 and excited to learn more. Your feedback helps me bring you even better content. All right, let's jump right into it without any fluff. There's this fresh IRS provision that's flying under the radar, and it's set to shield a chunk of your hard-earned retirement funds from Uncle Sam's grasp every year, specifically tailored for folks 65 and up or couples where both are in that age bracket. And trust me, this isn't some hyped-up myth or partisan spin. It's legit legislation that's already on the books and could mean real dollars staying where they belong, in your wallet. The beauty of it is that while most retirees are pinching pennies, sticking to tight budgets, and avoiding dipping into nest eggs unnecessarily, the government tweaks these tax rules quietly without fanfare. No personal alerts or splashy news blasts, so overlooking it could cost you big time down the line. We're going to unpack this methodically, keeping things straightforward, ditching the confusing lingo, and focusing on what it truly means for your bottom line. First off, grasp why this tweak is a big shift. It's not your run-of-the-mill inflation bump that nudges figures up a tad each year. Nope, this is a brand new extra write-off aimed squarely at older Americans. And unlike perks that favor the wealthy with fancy portfolios, this one's geared toward everyday retirees scraping by on steady but limited inflows like pensions or modest investments, which is precisely why it's sneaking past so many radars. No primetime coverage, scant mentions from accountants yet, but it's potent and very much active. Here's the magic figure to etch in your mind: $6,000. That's the added shield for a solo filer aged 65 or more. And if you're hitched with both partners qualifying, it jumps to $12,000. Straight-up income that might escape federal taxation entirely. No refunds or repayments involved, just pure preservation of your funds. Officially, it's dubbed the Enhanced Senior Deduction, but think of it as a bonus layer because it doesn't swap out your existing breaks. It piles on, so you keep your regular standard allowance plus the age-related extra for being past 65, and now this newcomer amplifies the protection, creating a multi-tiered defense that can seriously dial down what gets taxed, especially vital for those depending on Social Security checks, occasional pension payouts, retirement account pulls, or side gigs. To see why this layering is such a powerhouse, consider the typical deductions are often mutually exclusive. You pick one path, but here it's cumulative, slashing taxable amounts from various sources and potentially turning an owed balance into a clean zero or even a refund. Picture a straightforward scenario. A 67-year-old living alone pulls from Social Security, taps an IRA sparingly, earns a bit from savings interest. Pre this rule, deductions were capped, but now with this boost, extra thousands stay untaxed, flipping the script from paying in to breaking even or better, countering how rising living costs often outpace fixed incomes without adequate tax relief. Crucially, this isn't forever. It's locked in just for 2025 through 2028, so unless lawmakers renew it, poof, it's history, which underscores the urgency to strategize now, maybe timing distributions from savings or juggling work hours to maximize benefits during this narrow time frame. This measure targets everyday middle-class elders, not the ultra-rich, those grappling with inflation's bite on essentials, hence the built-in income caps we'll detail shortly. But even if you're not at rock-bottom earnings, partial eligibility could still yield worthwhile savings. Importantly, it doesn't outright erase taxes on Social Security. That's a separate beast, unchanged. But by trimming your total taxable pie, it can lessen or nullify the portion of benefits that gets hit, delivering indirect yet tangible relief that's often overlooked. The harsh reality? The IRS won't hand this to you on a platter. You must claim it properly or it's forfeited, and retro-fixing errors post-filing is a hassle, so staying informed is key to avoiding costly slip-ups. On a cautionary note, with any fresh senior perk, fraudsters swarm in via phony calls, emails, or mailers peddling paid assistance. Remember, claiming this is free, no fees to the IRS. Standard software incorporates it if prompted, so steer clear of anyone demanding upfront cash or sensitive data.
Now, reflecting for a sec, wouldn't safeguarding extra thousands over these years ease worries, extend your reserves, or cover surprises? That's the core value here. Practical support in a squeezed economy, not drama or exaggeration. Diving deeper into the nuts and bolts where confusion reigns, folks latch on to that $6,000 or $12,000 headline and figure it's universal. But nah, it's modulated by your earnings, so let's clarify those boundaries to gauge your personal gain. Income thresholds are in play since it's meant for lower to moderate earners. For singles 65 plus, full access up to $75,000 AGI. Then it tapers off, vanishing at $175,000. For joint filers, both qualifying, full up to $150,000, phasing out to zero at $250,000. If below the start points, grab the max. In the middle, snag a slice. At every bit counts. The taper mechanics are mercifully simple. Over the limit, for each grand extra, dock $60 from the deduction. So a single at $85,000 is $10K over. That's 10 times $60 or $600 shaved off, leaving $5,400 still in play, which can nudge you out of higher brackets or minimize Social Security taxation ripple effects, influencing even Medicare costs. Don't dismiss partials. They compound impacts, especially near bracket edges or when juggling multiple income streams. And yes, this applies even if you're moonlighting or consulting post-retirement. No full-stop retirement mandate, just hit the age and income marks, fitting today's gig-heavy landscape. Regarding standard versus itemized, no forced choice here. This bonus overlays either approach, offering versatility without overhauling your setup. Claiming it right is straightforward but essential. Opt for Form 1040 SR, the senior-friendly version with bigger text and guides. Tick the age confirmation box as it unlocks doors, then fill the new attached schedule for calculation. Good software walks you through, or quiz your preparer to confirm they're clued in. Don't presume. Busting a major myth, no, it doesn't zap Social Security taxes directly. That's misinformation. Instead, it shrinks overall incomes subject to tax, which might indirectly shield benefits from levies, sometimes fully, but plan accordingly to avoid missteps. In dollar terms, for a $6,000 qualifier in the 22% bracket, that's roughly $1,320 kept. Real-world wins like meds, bills, or buffers. Double for couples, amplifying relief. With the 4-year sunset, it's prime time to optimize, perhaps defer or front-load incomes, align work, using the system smartly, not slyly. Reiterating the scam alert, imposters posing as officials will hustle for fees or info, claim solo or via trusted free tools, no rush tactics from legit sources. Ultimately, this provision empowers you to retain more earnings, but only if you're proactive. Learn it, apply it accurately, sidestep pitfalls. It doesn't bite the IRS if missed, just your finances. So, with this fleeting opportunity to fortify your golden years, how will you leverage it for lasting security before it slips away?